Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sensetime Group Inc. Annual Report. Sensetime Group Inc. offers a diverse range of businesses and services that cater to various industries. At its core, the company provides artificial intelligence, AI, software platforms for digital transformation, smart city management, IoT devices, and metaverse technology. These platforms include SenseFoundry Enterprise Platform, SenseMe, SenseMars, and SenseCare Smart Health Platform. In addition to AI software platforms, Sensetime Group Inc. offers various services such as AI as a service, artificial intelligence, data center services, software development services, information transportation, and software and information services. The company also sells software-embedded hardware and related services, making it a one-stop shop for businesses looking to integrate AI technology into their operations. Furthermore, Sensetime Group Inc. is involved in private equity investments and the research and development of computer vision technology and AI technology. The company develops and sells software products, AI sensor technology, and system integration technology, as well as hardware products. Its services also extend to education through its Sensetime Education platform, which builds an AI education system. Overall, Sensetime Group Inc.'s extensive range of businesses and services positions it as a leading player in the AI industry, with a presence in mainland China, Northeast Asia, Southeast Asia, and internationally. Sensetime Group Inc. market capitalization of $82 billion is significantly larger than the average industry peer of roughly $5 billion. This shows that Sensetime Group Inc. holds a significant advantage in their industry. Sensetime Group Inc. trades at a higher price-to-book ratio of 2.51 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 32% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline for a company can be identified through various financial indicators. In terms of revenue growth, several factors contribute to this increase. Government grants have been a significant contributor, with an increase of RMB 98,897. The development and sale of software by Shanghai Sensetime Digital Technology Co., Limited, has also played a crucial role in driving revenue growth. Another key factor is the research and development R&D expenses eligible for super deduction, which can be claimed as a tax benefit. Additionally, an increase in trade receivables from 6,973,566 RMB 0 in 2024 to 5,895,344 RMB 0 in 2025 indicates that customers are paying their debts on time, contributing to revenue growth. On the other hand, there are several factors that contribute to revenue decline. The uncertainty of Pillar 2 legislation in Chinese mainland and its impact on tax liabilities has led to a decrease in revenue. A decrease in deferred income tax liabilities by RMB 3,624,000 also indicates a reduction in revenue. Furthermore, an increase in provision for impairment of inventories by RMB 8,999,000 suggests that the company is experiencing inventory issues, leading to a decline in revenue. In conclusion, identifying primary drivers of revenue growth or decline requires analyzing various financial indicators. By understanding these factors, companies can make informed decisions to mitigate risks and capitalize on opportunities for growth. The company's debt level and interest expenses have undergone significant changes in the past year. In terms of debt level, the total borrowings have decreased by RMB 197.2 million, from RMB 5,921.8 million to RMB 5,724.6 million. This decrease is also reflected in non-current liabilities, where borrowings have reduced by RMB 971,129. However, there has been an increase in the current portion of non-current borrowings, rising from RMB 211,960 to RMB 1,097,749. The total debt has decreased by a substantial 35.3%, from RMB 33,814 in 2024 to RMB 21,936 in 2025. This reduction is a positive sign for the company's financial health. On the other hand, interest expenses have increased. The interest expense on bank borrowings rose by RMB 10,268, while the overall interest expense increased by RMB 1,456. However, the weighted average effective interest rate for borrowings has decreased from 2.89% to 2.52%, indicating a slight reduction in borrowing costs. Overall, the company's debt level has decreased significantly, but interest expenses have increased. Management's outlook on company strategy. The company's management team is optimistic about its future prospects, with several key initiatives underway to drive growth. One of the most significant developments is the launch of a new model based on the second-generation NEO architecture in Qtwo 2026, which will enable the validation of a new scaling law under native multimodal architecture. In terms of revenue and gross profit growth, management notes that these metrics have increased by 33% and 27%, respectively, year-over-year. This growth is attributed to cost control measures and improved operational efficiency, which have helped reduce operating losses. The company's treasury management approach remains prudent, with interest rate exposure maintained on a floating rate basis. Management also plans to identify new investment opportunities in companies related to its core business to create synergies and improve services/products for customers. In addition, the company is expanding its offshore value-added telecommunications business through its overseas subsidiaries. This expansion is expected to contribute to the company's growth strategy. Overall, management's outlook on the company's strategy is positive, with a focus on driving growth through innovation, cost control, and strategic investments. The company's financial transactions over the past period have been characterized by a lack of significant acquisitions. The only mention of an acquisition is related to investments in financial assets at fair value through profit and loss, but the amount involved is not specified. On the other hand, there are several instances of divestitures mentioned in the extracted summaries. One notable instance is the decrease from disposals of subsidiaries, which amounts to 350,080. This suggests that the company has been actively selling off its subsidiary businesses over the period. The company's dividend policy is a notable aspect of its financial strategy. According to the provided information, the company has indeed paid dividends. This can be seen in multiple instances across different pages of the report, where it is explicitly stated that the company has distributed dividends to its shareholders. This decision to pay dividends suggests that the company is committed to returning value to its investors and rewarding them for their investment. It also implies a certain level of financial stability and profitability, as companies typically only consider paying dividends when they have sufficient cash reserves and earnings. Overall, the payment of dividends by the company indicates a focus on shareholder value creation and a commitment to maintaining a strong relationship with its investors. That concludes the financial summary for Sensetime Group Inc. Feel free to comment below, and I will be happy to answer them when possible.